One of the main things that happened with this tax act is that it extended the existing federal income tax rates for another 2 years. What would have happened is the 10% bracket would have been gone, and the top end tax bracket would have went up another 4.6% if this act was not passed. It also extended the lower capital gains tax rate and the tax rate we pay on dividends. Once you figure out what your alternative minimum taxable income is, you get an exemption deduction. And that was extended for 2010 and 2011. It hasn't been extended for 2012, just through 2011. And for a married filing joint couple, you basically get an exemption of $72,000 or $74,000 for 2010, 2011. Without this patch being put in place, your exemption would probably be right around $45,000. So that would have, you would have another $30,000 of your income subject to this AMT tax at 26 or 28%, just depending on how high your income is. So this is a very significant piece of legislation that got passed. We can really choose what assets we want to expense. Work with bonus, work with Section 179. Well, how can we maximize the deduction? So we can go through and do a cost segregation study and pull a lot of those costs out of the 39-year building component and depreciate those over 15, 7, or 5 years. But once we do that, we've got those components identified. If they're the 5, 7, or 15-year property, then we can apply the bonus, apply the Section 179, apply all those rules, and hopefully be able to, just looking at those numbers preliminarily, get a pretty big tax deduction. If you don't do a cost segregation study and you throw everything into 39-year property, you're depreciating that cost over 39 years. Here, we at least pull it out, you get 5, 7, or 15-year depreciation. And then on top of that, we can identify stuff and take that bonus in Section 179.